You know, one of the most common mistakes I see entrepreneurs make is assuming that all growth capital is the same. That's what I believed when I first started in my career as an entrepreneur. You need money, an investor offers money, and you assume, I have a solution. Somebody's willing to write a check. But capital has different characteristics. Different investors have different objectives, different time horizons, different expectations, and probably most importantly, different tolerances for risk. Now, in many cases, the wrong source of capital can actually slow a company's growth or, as has happened to me, put a business at risk. Over the course of my career, I've raised more than $75 million in venture capital, strategic investments, and debt financing. And one of the lessons I've learned is that successful founders don't just raise capital, they raise the right capital at the right time from the right investor. So, let me explain what I mean. You know, the news media is filled with stories of venture capital funded startups that are launching new products and services. And as a result, many people assume that venture capital is the primary source of growth funding for emerging companies. In reality, venture capital is only one form of growth capital, and in many situations, it's honestly not the best choice. Different capital sources have different objectives. They obviously have different risk tolerances, which we're going to talk about. They have different time horizons and different strategic motivations. And understanding those differences can be critical to a company's success. So let me show you why, right? So capital sources have different attributes. And this is something that took me a while to learn as an entrepreneur, but it became really valuable once I learned it. Some investors prefer to invest early in a venture's life cycle, often called angels, right? While others prefer to wait until a business is more mature. That's a risk tolerance piece, right? Some invest largely based on the character and reputation of the founder, while others focus on the operating performance and the future prospects of the business. I mean, I've had people write me a check and say, Mark, I believe in you, right? And I'm thinking to myself, what about the business plan? Do you like the model? Do you like this? Do you like that? No, they have confidence in me, right? Some investors can make decisions in days, while others require months of due diligence. And if you're a founder and you're sweating bullets and you've got negative cash flow and your burn rate is high, that lengthy due diligence can be brutal, right? Some investors are motivated primarily by financial returns, but others seek strategic business benefits beyond simply the cash, beyond the investment. Now, in the three businesses that I founded that required external capital, my first investors were almost always high net worth investors. These investors had confidence in me and my founding teams and were willing to make decisions very quickly. We could do a pitch, they could wait, they could get back to me in days, maybe a week, and say, I'm in or I'm not in. Mark, this is not for me. Ooh, I like this. I'm going to be a part of it, right? In the early days of these ventures, that speed mattered because we didn't have any revenue and we were totally dependent on outside capital to survive. I mean, this is how we paid the bills. This is how we kept the doors open. This is how people were able to feed their families, right? It was the quick decisions of these high net worth investors. Now, what may surprise you is that in two of these three companies, my next source of capital was not venture capital. A lot of people assume, okay, I'm going to do an angel round, I'm going to do a pre-Series A, I'm going to do an early round, and then I'm going to do a Series A with some venture capitalists. That's not what we did. We sought strategic corporate investors, companies willing to invest substantial sums, not only because they believed in our business plan, but, and this is key, our success could strengthen their own businesses, right? So unlike traditional venture capital investors, these strategic investors were less focused on maximizing the value of their ownership stake. I mean, I don't want to say that wasn't important. It was important, but they were far more focused on how our success could enhance their core operations. They recognized that if our company succeeded, they would benefit both as investors and as business partners. Now, one of MobileStar's strategic investors was Proxim. It was a Silicon Valley-based manufacturer of wireless communications equipment. When Proxim invested in us, and it was early, Proxim wasn't simply making a financial investment. They were actually helping create demand for their own wireless networking products while accelerating our ability to deploy networks at scale. You can see the win-win here. It was very clear, right? They would sell technology and did sell technology to us that we would deploy in our network. but it also helped validate us. Their investment sent a powerful signal to other investors that our business model was credible and that industry participants believed in our future. And that matters when you're small, right? Now, only after securing support from high net worth investors and strategic corporate investors did we then turn to the classic institutional venture firms, right? But by then, honestly, we'd achieved critical mass. We built our team, we expanded our network footprint, we'd begun signing customers, end users, and then, of course, we had our venue partners such as American Airlines and Hilton Hotels. So our vision was no longer just theoretical. As I said in another video, our promise to the end user, right, of our network was we'll be with you everywhere you sleep, eat, move, and meet, right? It was no longer theory. It was actually becoming a real business. Now, as a result of that, when we then went, and now I'm talking the third type of investor we went to, in this case, Mayfield Ventures, they looked at us, this is for our Series B, they looked at us as a much lower risk opportunity than many early stage ventures. And following extensive due diligence that was actually led by another venture capital firm, Blueprint Ventures, Mayfield invested $25 million as a part of a $35 million Series B financing round, right? But in this case, the venture capital firms brought far more than money. And this is where, again, when you talk to people about capital and the value of the different types of capital, this becomes really important. They introduced us to a network of relationships that became critical to our success. And one of those introductions was to Starbucks. Now, at the time, Starbucks operated approximately 3,500 retail locations across the U.S. And after that introduction, we were able, it took us 6 months, but we were able to negotiate an agreement to deploy our wireless network throughout their retail stores. And this was for us a transformative opportunity for MobileStar. I mean, with that transaction, we had, on paper anyway, the largest national Wi-Fi footprint in the United States. Nobody had this, right? It accelerated our growth, it strengthened our market position, and it helped establish us as the leading provider of public access Wi-Fi services in the U.S. and eventually around the world. Now, here's what I want to point out. Each class of investor contributed something different during our capital campaign. Some could act quickly when timing was critical, as in the early days. The high net worth guys could write a check quickly, 25, 50, 100K. It made a huge difference in our ability to remain solvent and our ability to achieve our promise, right? Others brought strategic business relationships that accelerated growth for both companies. And I talked about Proxim earlier. That's what they did. Venture capital firms contributed industry expertise, credibility, but also these introductions that opened doors that honestly we couldn't have opened ourselves. Now, what I learned through these transactions is that capital providers often invest for very different reasons, right? An angel investor, a strategic investor, a venture capital fund, a private equity firm, a corporate partner, they're all going to write checks, right? And to a lot of new entrepreneurs, cash is cash, and I get that, right? But each of these different investor types, if you will, evaluate opportunities differently. They negotiate differently, trust me on that one. And most importantly, they measure success differently. Now, in litigation involving venture financing or business valuation, commercialization strategies, partnerships, shareholder disputes, claims regarding access to capital, understanding all of these distinctions can really be critical. Having raised capital from multiple sources and negotiated with investors across several decades, I helped my attorney clients explain not only how financing transactions were structured, but why the parties made the decisions that they did. If this resonates with you or a matter that you're dealing with now, reach out. Let's talk.